Hey everyone, I'm taking a little break from writing MMT Trader and I'm going to do this video and I'm going to call this video the reverse wall of worry, okay? Many of you have heard this expression, this phrase, the wall of worry. The market climbs the wall of worry. It's an old Wall Street adage, meaning that people they always have a tendency to be nervous about the stock market, cautious, fearful about the stock market, and that fear and that caution keeps them a little bit hedged, a little bit out of the market, right? And always thinking that there's a crash just around the corner. And the market kind of creeps up on this reluctance and this hesitancy. It climbs the wall of worry. And the times that you got to be concerned about the market is when the wall of worry kind of goes away, and we saw that with the whole entire Trump rally. I had people even here on this channel posting up comments telling me, Mike, it's going to be totally different. It's going to go straight up. It's never going to come down, which is ridiculous. Now, I'm on record, and you know this, I'm on record as saying that over time, the stock market always goes higher because basically it is a growth function. That's what the stock market is. It reflects the growth of a society, the desire by people and firms to do better, to prosper, to advance their position, their situations in life. Some people, anyway. I mean, we know there's people on here who are on this channel who decide that hey, they're just going to stay down, and they accept that. But I don't want to get into that again. So now I'm calling this the reverse wall of worry. And the reason why I'm calling it the reverse wall of worry is because I saw an article on Yahoo Finance where the author tried to argue that the market's never going to go down because people are, they're always concerned and fearful, so they hedge. They buy insurance of some form. They buy puts, or they buy other products or they sell short stocks, positions or strategies that protect them on the downside. This to me is, when I hear something like this, it's kind of like throwing in the towel by the authors saying it's just never going to go down. All right. So this is the reverse wall of worry. And, I'll give you an analogy. Just because you have auto insurance doesn't mean you can't get into a car crash. Okay. Just because you have fire insurance on your home doesn't mean your home can't burn down. All right. Just because you have insurance does not mean that the markets, certain periods of time, are going to reflect a deterioration in basic economic conditions. And that's what I'm arguing right now. And I've been arguing that we are seeing, it's not conjecture, it's not speculation on my part. The economic conditions have been deteriorating. Economy's slowing down. Fiscal flows are flat. Bank credit growth is collapsing. Gasoline demand is recession level, we're seeing. So the market can react. Yes, over time it does go up. As investors, we like it when the market goes down because it creates opportunity. There are tremendous buying opportunities in high quality stocks and other investments. So anyway, I just find this to be funny that, because people bought insurance, it can't go down. I was a trader for a long time, and I still am. I was a floor trader. There were times when I made money on my short positions and when I made money on put options. Okay, that happens. So this guy who thinks it's never going to happen, and that causes the market to constantly go up, that's kind of a funny and almost a contrarian, view. So this is the reverse wall of worry. And actually, if you think about last year, where we did have the wall of worry, where investors were afraid of everything, the oil price sell-off at the beginning of the year, and then we had the Brexit situation, and then we had the lead up to the election, and all these fears. And I was saying, in fact, I was using the phrase all last year that the market's climbing the wall of worry. It's a wonderful environment, bull market, because it's a stealth bull market. Nobody sees it. But then when it goes parabolic, like when it did towards the end of the year and beginning of this year, that's when you want to get out. Now this is like a stealth bear market. right? We opened up today. Look at today. It's a beautiful day. I mean, we opened up down almost 200 points. Now what? We're down 50, 60 points. Everyone, hey, the coast is clear. Everything's wonderful. So, they get sucked back in again. But the conditions are deteriorating. And we have this slow, gradual decline. It's the proverbial, a story of the frog in the pot of water. And you're heating up the pot of water. You put it in. You start heating up the water. It doesn't feel it. It doesn't feel it. It doesn't feel it. By the time it feels it, the frog is dead. Okay? You're not throwing it in a boiling pot. That would be the crash, and everybody just liquidates in one shot. No, this is a slow, gradual. So I really think it's gonna persist. We'll see what's gonna happen. I mean, the news-driven events of the markets now is going to be whenever something comes out about this tax reform. But I'm telling you, folks, you load your advisory panel with a bunch of fiscal hawks and deficit hawks. I mean, how much tax reform do you expect? How much fiscal stimulus do you expect? These guys think they got to go get money from the Chinese. I mean, come on. If it was just Trump, when he started out in the campaign, with all these, you got Gary Cohn, the guy who was the CFO of Goldman Sachs, saying, and I did a video on this, equating the federal government, a creator of money, an issuer of currency. This guy, CFO of Goldman Sachs, you can't really get much higher than that in the financial industry, saying the government's like a household. Does not understand. So, I would chill a little bit on this expectation of massive fiscal stimulus. You don't have the right people in there. You just don't have the right people in there who understand the monetary system, who know that there's no constraint on spending whatsoever. And that's not just the White House. That's the whole entire Congress, okay, including the Democrats. Anyway, the reverse wall of worry, people. That's what it is. Oh, yeah, one more thing. Let me add one more thing. In doing the report today, I'm writing it. This is a very nuanced this week. I mean, the prior reports for the past, several weeks, if not several months, they've been boom, boom, boom. I mean, we had big developments like the slowdown in credit growth and the gigantic, enormous, positions of asset managers in the market and all this stuff, really explosive, big stuff almost every single week. And now this is going to be there's little things going on, but that doesn't make them less important. They're giving signs, they're giving signals, all right? It's going to be a very important issue to really take to heart and study. It's not going to be wham in your face. We got this big item out there, but little things that are I think are tipping the hand of what's going to happen next. So be on the lookout for it and come out later. Bye-bye.